tax reform legislation, signed into law at the end of 2017, makes major changes to the U.S. tax code for individuals and businesses. This video focuses on changes for individuals. Most provisions in the new law take effect January 1st, 2018, and generally will not affect your 2017 tax return. That return is covered under the old rules, with minor exceptions. You'll have to wait until you file your 2018 taxes, due April 2019, to see exactly how the new tax law will affect your bottom line. In addition, tax changes affecting individuals are set to expire at the end of 2025. If a new law doesn't extend them, these provisions will revert to 2017 rules. The new law keeps 7 tax brackets, but lowers rates in 5 of the brackets. The previous rates of 10, 15, 25, 28, 33, 35, and 39.6% have been changed to 10, 12, 22, 24, 32, 35, and 37%. The income levels in the brackets have also changed. Here are the brackets for single and joint filers. See where you fit in. The new law retains the individual alternative minimum tax, but significantly increases AMT exemption amounts, which will limit the number of taxpayers caught in the AMT net. One of the major hallmarks of the new tax law is a near doubling of the standard deduction to $12,000 for single filers, $18,000 for head of household filers, and $24,000 for joint filers in 2018. The increase means fewer taxpayers will need to spend time itemizing deductions because the standard deduction will be higher than their qualifying expenses. In exchange for larger standard deductions, the new tax law eliminates personal exemptions, which were $4,050 for each individual claimed on a tax return. So, for example, a family of 5 would lose $20,250 in exemptions in exchange for an $11,300 increase in their standard deduction. For many families, the loss in exemptions will be balanced by a higher child tax credit. The new law doubles the credit from $1,000 to $2,000 for each child under age 17 and significantly increases the income thresholds to qualify, up to $400,000 adjusted gross income for joint filers, and up to $200,000 for all other filers. The tax law also creates a new family credit of $500 for each dependent who is not a qualifying child, for example, a college student or a disabled adult child. For taxpayers who itemize, the new law makes a number of changes to individual deductions. There is now a $10,000 cap on the amount of state and local taxes you can deduct. This includes property taxes, plus either income or sales taxes. Tax breaks for homeowners have also been tightened. For mortgages obtained after December 15, 2017, to buy or improve a principal residence or second home, the amount of debt on which homeowners can deduct mortgage interest has been reduced from $1 million to $750,000. Older mortgages are grandfathered under the $1 million cap. In addition, the new law eliminates the interest deduction on new and existing home equity debt that is not used to buy, build, or substantially improve a qualifying residence. The deduction for medical expenses was initially on the chopping block, but the new law is more generous than the old one, at least temporarily. Under the old rules, medical expenses were deductible only if they exceeded 10% of adjusted gross income. Under the new rules, this threshold drops to 7.5% of AGI for 2018 and for 2017. In 2019, the 10% threshold returns. And starting in 2018, casualty losses can be deducted only if they occur in a presidentially declared disaster area. The new law contains a number of miscellaneous changes as well. The individual mandate, which is the requirement that you have health insurance or pay a fine, is repealed, but not until 2019. It remains in place for 2018. The new law puts a one-and-done stamp on Roth conversions. Starting in 2018, once you convert a traditional IRA to a Roth IRA, you can't undo it. And the estate tax, originally slated to be revoked, lives to see another day, but will apply to fewer taxpayers. The new law doubles the amount that can be left to heirs tax-free in 2018 to approximately $11 million for single filers and $22 million for married couples. These amounts will increase each year to keep up with inflation. This list does not include all the tax changes in this complex piece of legislation. If you have questions, call your tax professional for more information.